for what common products and features you might see out there in the marketplace, how you can evaluate some of those different products and features in the context of your situation, and also steps that you can take today to start doing some planning for yourself and your family. So let's get started. First thing today, we're going to talk about terms and definitions. This is going to lay the groundwork for any planning you might want to do. And then we'll move on and we'll talk about some things to do, some things to not do, and then how you can start your planning today. And then lastly, we'll wrap up and make sure you know who we are here at Brighton Jones and how we're available to help. Before we begin, a quick word about insurance in general. Insurance is about managing risk at a basic level. There are risks out there. For instance, the risk that we get into a car accident and expensive damage is done to our car, or the risk that a fire causes damage to our home. Or, and here's where life insurance comes in, the risk that we die prematurely and our future income that may be providing lifestyle, retirement for our family, or funding education for our children, or covering a mortgage, so on and so forth, that future income ends. That risk can be borne by people. You can do what is called self-insure, take it on, meaning that maybe a family with 2 working spouses can just decide that if one person passes away, the other will provide for the whole family, or that an extended family could step in and help, or friends or community, and so on and so forth. Or you can take that risk and transfer it to an insurance company in the form of a life insurance policy. So when considering if buying life insurance is right for you and how much might be appropriate, it's important to think about what risk you are comfortable taking on self-insuring and what risk you want to transfer to an insurance company. We'll talk more about that as we go. And one final note before we dive in, if you do ever replace one insurance policy with another, be that life insurance or any other kind of insurance, never cancel the old policy until you have confirmed and reconfirmed that the new policy is paid up and in force. You don't want to risk being without coverage even for one day. Okay, terms and definitions. Let's get started here. What is life insurance? Well, life insurance at a basic level is a contract between a policyholder and an insurer or insurance company. These contracts come in many different forms, several of which we'll discuss today. And basically a policy holder agrees to pay a premium to an insurer, an insurance company, and that insurer agrees to pay a death benefit if the insured person dies while the policy is in force. So that's the basics of a contract. And as part of the process, the insurance company underwrites the policy, which means they assess the risk and decide if they want to issue the policy and set the pricing. This involves a medical examination, blood tests, a review of personal and family medical history, and coverage can be priced very high or even declined if there are perceived risks that an insured person won't survive long enough for it to make financial sense for the insurance company to issue the policy. So that's going to be a theme across all of the different kinds of policies and products, is that underwriting process. What kinds of insurance are out there? Well, there's term life insurance. So features of term policies are fixed costs and specific time periods. If you buy a term life insurance contract, it's in force for a specific number of years or a term. 10, 15, and 20 years are the most common that we see. Sometimes we do see longer, up to 30 years. When the term is up, either the contract ends or sometimes it can stay in force, but the premiums could skyrocket to the point where it's impractical to keep it. For all intents and purposes, when you have a term life policy, once you get through that term, that policy is usually no longer useful. One kind of term insurance is what's called level term. This is what we see most commonly and what we typically recommend when people pursue term insurance. It means that the premium is guaranteed for the life of the term. If your premium is $500 annually, it will always be $500 for the entire term as long as you pay it on time and your contract will stay in force. Another kind of term is decreasing term. In these policies, the premium stays the same, but the death benefit decreases over time. Because of this, the premium is typically lower than with a level term policy. So, if premium cost is a concern, that can be something to consider. And then there's also what's called annual renewable term. Coverage here is guaranteed, so you're guaranteed your coverage for the whole term, but not the premium. So those can and most often do go up over time with these policies. So it can start out being very affordable, but then as the term goes, the cost can rise. And separate from term insurance, which again covers a term or a period of time, there is permanent life insurance. That's insurance for life. Life here is deliberately in quotes because these policies do expire, but usually not until age 115, 120, 121, 125 or something like that. So unlike a term policy, if you keep paying the premiums, at some point these policies will pay a death benefit. One kind of permanent life insurance is whole life. It has level premiums and a fixed death benefit, meaning that they're both stable for the life of the policy. And there's also the potential with these policies that you can be paid dividends by the insurance company that will offset a portion of the premium. Oftentimes when these are marketed or sold, the premium is shown net of an estimated dividend, which can make it look less expensive and more attractive. But it's important to keep in mind, and you'll hear me say this throughout a couple of times, but illustrations, estimates are just that, illustrations and estimates. There's no guarantees that dividends will be a certain amount and that premiums will be a certain amount if they're shown with dividends or other kinds of income incorporated. Also in the realm of permanent life insurance, there's what's called universal life. It's a different kind of permanent insurance. It has flexible premiums, meaning you can pay in different amounts over time. And it also has a flexible death benefit. And it's ultimately a combination of how much you pay in premiums and how much interest and or dividends are credited to your policy that determines how large the death benefit is. So same thing here, when these are marketed and sold, they will include an illustration of potential values. So, if you pay these premiums and the interest crediting is this much, then over this period of time, here's what the death benefit will be. But again, important to remember that these are just illustrations, not promises or guarantees. There's typically a minimum guarantee, but that will be much different than what the illustration shows. There's also variable life. Variable life is a kind of permanent insurance that has level premiums that you can direct into what are called sub-accounts for investment. Think of it a lot like a 401k. There's different funds that have different market exposures and cost structures, and it's really how much you put into the plan, how much you pay in terms of premiums, and where you direct those, and really what those investments do and how they grow that determines what the death benefit is. And then there's this variation on that called variable universal life, and it combines the flexible premiums of universal policies with the sub-account investments of variable policies. So it's flexible how much you pay into these policies. You could pay in the same amount over time, you can pay in a large amount up front, and then ultimately there's investments in sub-accounts that drive what the death benefit is. And with these with most permanent insurance, one of the features that is often marketed is the ability to tap into values before there is a death. So if there's you have a variable universal life policy that you've been paying premiums into and the investments have been growing, there are potentially ways to tap into some of that value before there is a death. Obviously, that would decrease the death benefit. But that is a feature of these that's often marketed as a benefit. So let's talk about a few features that you might see attached to these different kinds of policies. One is that these can be offered as group policies or group coverage, and that is insurance obtained through an employer or other organization, like maybe a professional organization or alumni group, or like AAA or some other kind of group or organization that you could be a member of. And the benefit of group coverage is that up to a certain amount, there's no need to undergo any kind of medical review. And the cost is also often lower than any one individual could get out in the marketplace. So there's some really good benefits there. The downside is that the benefits are tied to membership in the group. So being employed at the company or being an active member of the organization gets you access to this group coverage, but if you were to end your affiliation, you would lose some of the benefits. Some of the group policies are portable, meaning that an individual can keep them if they leave the organization. But if that does happen, typically costs go up considerably when you're no longer part of the group. But really, really great ways for people that maybe have some health issues are able to get coverage, whereas in an individual, they might not be able to get coverage because of any health concerns. So really great benefits there from being part of an organization. There's also something called accidental death and dismemberment, or AD&D. And this refers to when policies pay more in certain instances. Like, for instance, if there is a death while working or an accidental death, like a car wreck, the death benefit could be higher than it would be otherwise. Or there are amounts that can be paid out if non-fatal injuries occur, like losing sight or losing an arm or a leg. There would be cash benefits that would come from a policy like this. We most often see these attached to group policies, don't often see these sold individually, but they are out there. Survivorship universal is another feature, also known as a second to die policy, which covers 2 lives. Often this is spouses paying the benefit when the second individual passes away. These aren't as common when insurance is being used to, cover potential lost income. It's more common when insurance is being obtained for estate planning purposes, as in that context of funds, the liquidity, death benefit would not be needed typically until the second death. Premiums are usually lower here than if one person got coverage, because the insurance company can reasonably expect to collect for a longer period of time, collect premiums before paying out a benefit. So it can be a good way if, especially in those estate situations where it really is at the end of 2 lives that you need a benefit, it'd be a great way to save some cost. And then within the realm of term insurance, there's a feature called conversion, or convertible term coverage. And this would allow a policyholder to convert a term policy to permanent insurance without undergoing any additional medical screening. So it can be a great feature depending on how it affects the cost, because in many instances it doesn't materially affect the cost, and it's a good hedge against unforeseen situations. So, if near the end of a term, an individual maybe comes down with some health problems that could potentially increase the risk of a premature death, you could, keep coverage in place at a more reasonable cost, or, where you might not even be able to go out and get coverage at that point. So it's a, if a term policy seems right, but you want to kind of hedge against maybe I will need it longer than this term, having a conversion feature does that in a really effective way. And then policies can have non-insured ownership. The most common way that insurance is bought is, Jane Doe wants an insurance policy, so she buys it, and it's in her name. She's the insured person. She pays the premiums. But there are instances where a non-insured person could own the policy. So that would be when policies are owned by either an individual or an entity other than the person that's insured. Most often we see this if parents take out insurance policies on children. And so the parent would own the policy. the child would be the insured person, or if a trust were to own an insurance policy. The most common of these is what's called an irrevocable life insurance trust, and that would have some really good benefits from an estate planning purpose standpoint. So those are some of the features of policies that we might see. Hopefully that provided a pretty decent overview. So let's talk about how to approach this and what kinds of things to think through. So first we're going to talk about top five things to know. What are some of the main takeaways here? The first thing is celebrate independence. So what we mean here is when you're out looking for a policy, our general recommendation is to work with a broker who is not captive to one insurance company. And the reason is that different companies offer different products and different pricing and underwrite differently. So one company might charge you a higher premium if during the medical review, they learned that you had a parent who had cancer, or you had a parent who had heart disease, whereas other companies might not affect your premium as much for one of those things. And so an experienced broker who's familiar with several different companies and can place coverage with several different companies, in our opinion, offers a better chance that you're going to get a better policy for your specific situation, because they can ask you some questions and help decide which insurance companies are likely to give you the best product with the best pricing. Don't think just about what you have now. And so here we're talking about how to start thinking through a decision around coverage amounts. So there are some rules of thumb out there that might tie to a net worth or a current income, but in our opinion, what's most important is thinking about all that you have now, but also all that you want to have. Where do you want to be 15 or 20 years from now? What's your plan? What's your goals? What does that retirement planning look like? Are you going to be providing education for kids, things like that? What if something happens to you and the income that would have provided all those things goes away? Are you willing to compromise on some of those goals, or do you want to buy insurance to cover all of them? We get back to that, how much risk do you want to take on and how much do you want to transfer? But the key thing here is to think in the future, because for most of us, if we think about where we're going to be 15 or 20 years from now, that has involved some savings and some growth of our assets. And so insurance, and any insurance decision should take that into account. Buy for when. So at what point will you have built up enough of a nest egg to cover all those needs and dreams that we were just talking about? When are you in that financially free and flexible position? Because at that point, unless you have some estate planning considerations or other considerations, your need for insurance is probably gone, or at least it is greatly reduced. And so thinking about insurance in that perspective, life insurance, a term policy that lines up with your time horizon is a great way to keep the premium cost down. So something to consider. And along those same lines, laddering coverage can lower costs. We talked about decreasing term coverage, which has some similar ideas here, but maybe if you are thinking about your coverage, maybe your need won't be gone for 20 years, but after 10 years you won't need as much. So you can then maybe buy a 10-year policy for some coverage and a 20-year policy for some coverage. And so that can really reduce premiums not only up front, but obviously after 10 years, one of the premiums goes away entirely. So that can be a really good way to control costs and still ensure that you have the coverage up front that you need. And then the note that conversion is king. I really wanted to just reiterate that if you are considering a term policy, seriously consider a conversion feature. Often you'll find the cost is minimally different, if different at all, and it can just provide a lot of flexibility for future unknowns. So those are some things to think about and think about doing. Now, what are some things to avoid? Cleaning house, and along with it, accidentally throwing out any policies. Much of everything is going to be electronic these days, so it's not as much of a concern as it might have been, even 5 or 10 years ago. But electronic or otherwise, make sure that you know exactly where your policy documents are, and make sure that whoever would have to deal with the policy in the event of a death knows where they are too, and also knows who to contact and what to do. So I think cleaning house was just a way for us to say, make sure that you know exactly where everything is, make sure that everybody is in the loop and has all the information. Don't just clean it out and forget about it or throw it away. Also, don't delay. Now, take the time to consider needs and carefully shop for the product that is right for you. But once you figure out what that is, get the application done immediately, get the medical exam done as soon as possible. The underwriting takes some time, and so you want to get those things that you have control over, which is basically the application and getting the medical exam done. Get that done as soon as possible. A policy that is not in force does nobody any good if something happens. So once you decide what you need, go get it as quickly as you possibly can. Don't buy what you don't understand. That's, basically it encompasses a lot in that statement, but I think it's true in all respects. Costs are buried and hidden in many policies, and illustrations can have pages of disclaimers. If you don't understand it, if it can't be explained in a way that makes sense to you, I don't believe it's the right product for you. Not even knowing anything about what it is, if you don't understand it, I don't think it's right. And if it's, let's say something is pitched as a great tax savings vehicle and retirement planning vehicle, if you don't understand how you're paying for it and how the added cost might erode some of those benefits, if you don't understand and believe in the value of what is being presented to you, don't go any farther. Just look for a different product. And along these same lines, if it looks too good to be true, it's pretty well you can figure that it's too good to be true. Guaranteed returns from investments, and you see these in some annuity life insurance products or some of those, there's some guarantees that can be built into some of those variable products. What it really means is that the insurance company is guaranteeing itself and its shareholders that they can pay out this return and still make money. So that would beg the question, could you, with a less expensive and more transparent investment strategy, make more money as well? A lot of policies are marketed and sold as a combination of insurance and investments, and what we typically find is that this neither offers the best insurance or the best investment vehicles. So just be cautious. And don't over-rely on group coverage. It can be really attractive because it's so easy and inexpensive, but our membership in groups or employment at any one company can change. And with those changes, we risk losing group coverage or losing the favorable pricing of group coverage. And so even if you have what seems like really adequate group coverage, it might be worth getting some outside coverage to lock that in no matter what your future holds in terms of what group you're a part of. Maybe you determine that your entire insurance need is $500,000 and your group policy is for $400,000. So you're almost totally covered by your group. Still might be worth going out and getting, say, $250,000 in an individual policy where you have maybe a little bit more than you think you need, including the group coverage, but what you've locked in is that even if you lose that, you still do have a base of coverage that is going to be yours for as long as it lasts. If it's term, for the whole term. If it's permanent, then permanently. And as long as you keep paying that premium, no one's going to take that away from you. That can be a really smart thing to do. So now let's plan for it. What steps can you take today to get started? Well, the first thing to do is consider your needs. What do you want to protect? How much are you willing to take on yourself, and how much do you want to transfer to an insurance company? When do you need this coverage? What policy features have we talked about or have you read about that might apply to your situation? Think about what you're looking to cover. What risk are you trying to insure? Think about that first, and then you can start thinking about the products that are out there. And from what you know, what do you think is going to be the best fit? So knowing what you want, or at least knowing what direction you want to go before entering into a discussion with a broker who is in effect a salesperson, that's always a good idea. That way, you reduce the risk that you get sold something you don't need if you have a clear idea of what you're looking for going in. And then once you've done that, once you've thought about your needs and determined the direction you think you want to go, then engage with a broker. Try and find somebody you can reasonably know and trust. So a referral from somebody you know, a referral from somebody you trust, be it a friend, a family member, another trusted advisor like a financial advisor or an attorney or a CPA, that's always good. And remember, we recommend avoiding brokers who are captive to one company. That's not to say that that one company might not provide the best product. They might for certain individuals, but by going to somebody who can shop multiple companies, I think you're getting a better chance that you end up with a better product. Once you've started, move quickly, get that coverage in place, and then revisit your coverage every few years, or if you have life changes, like maybe you change jobs, you move, you have a child, etc., things like that. And revisiting coverage just means taking stock, thinking about, okay, what was my situation when I went and got this coverage? How has my situation changed? Maybe, my mortgage is lower now. I've saved more for retirement now. So do I still need all that coverage? Maybe you can reduce it and save some premiums, or maybe something's changed, like you had another child and you need to add more. It's just good to kind of go through these steps again every few years. Consider your needs, think about the best product, then inventory the products you have or the coverage you have through groups, and think about where those gaps are and where you might need to fill in with additional coverage, and then engage with a broker. So with that, I'll open it up to some questions. And I have one here. Do you think that one type of life insurance is the best? That's a great question. No, I think is the short answer. I think that different types are more appropriate for different situations. Generally, I'll say for most, quote, regular people, I think term insurance is a great place to start. It helps cover a period of time when your risk is the highest, but at a very, very low cost relative to other options. Now, it's true that there are some types of permanent insurance that can grow in value and that you can access before you die for maybe one-time needs or for retirement income. But we find that when we look at these, typically the expenses are high to the point where the benefits are quickly worn down to where you probably be better off buying cheaper insurance and investing more into a vehicle like your 401k. Here's another. I know you talked generally about coverage levels, but can you be more specific about where to start? You bet. I can definitely try and add a little bit to that. Typical places to start are to think about how much debt you have, what your income is, and what kinds of other more significant expenses you would have, like maybe you want to fund education for a child. So how much debt do you have? What's your income? And do you want to provide education or some other kind of financial benefit to a loved one? So all of those things are going to be affected by a premature death. So you could just start by just adding them up. And for your income, think about how much you make over the next 10 to 20 years, depending on where you are in your career. Or maybe you choose a time frame like, well, your kids are going to be out of the house in 11 years. So how much money are you going to make over the next 11 years? And then, add that to how much debt you have and what education might cost, and take that number and start there. And then if you know you're looking for term insurance, you can easily connect with a broker and get pricing for $1 million. And then you can figure out pricing for different levels from there because it's pretty proportional. So, $250,000 is going to be 1/4 of the premium. $2 million of coverage is going to be double the premium. And so I think where to look I would say start with what's that high amount that you would want. Like if you wanted to cover everything, what's that amount? What's that going to cost? And then it's all about finding that sweet spot between fully insuring everything and paying a premium that's reasonable for you to work into your ongoing expenses. Maybe you find out that that big number is going to cost something that you're willing and able to cover, and it's not going to affect your lifestyle, and so you decide to just go for it. Or that premium is going to be quite a lot, so you start thinking about, okay, well, maybe I don't have to cover my entire mortgage because we could always, the house could always be sold, or maybe we won't cover all of education because there's always scholarships or loans or, things like that. And then just one note on that front is that depending on your income, there's going to be a certain level of insurance that you can't buy. So, if you make $70,000 a year, you're not going to be able to get $7 million in life insurance coverage. So there are some guardrails here, but I think that would be a pretty decent place to start. Okay, I'm going to stop there for today. Thank you again for tuning in. And remember, we here at Brighton Jones we're here to help. On the webinar page that I mentioned earlier, info.brightonjones.com/financial wellness, you can find our contact information. Please don't hesitate to reach out. We can talk through any 401k related issues, help answer other questions you might have. We'll do our best to help whatever it is that you need. And Brighton Jones does offer comprehensive individual services as well, which we're always happy to discuss with anyone who might be interested. Thank you again, and we'll see you next time.